the question is, why does a company cut its dividend? Often a company cuts its dividend because it didn't make as much profit as it was making before. Other times a company may cut its dividend because it got too much debt. On the other hand, if a company says, we're reducing our dividend this half year because we've just made that wonderful acquisition, small bolt-on, and we got a real bargain on it, and that should deliver far more than we paid for it over the next couple of years, then you may say, okay, that's sensible. I don't mind that they cut the dividend. So the fact that they cut the dividend is usually a warning sign, but have a look at why.
Welcome back to the Teaminvest Wealth Builders podcast and another episode of Wealthy and Wise, our collaboration with Ausbiz. Each week, we step away from the daily market noise and take a closer look at what it really means to invest with discipline and clarity. On Wealthy and Wise, we break down the principles of value investing, exploring the difference between price and value and how to make rational, long-term decisions in any market environment. Our conversations focus on practical frameworks, not jargon, using real companies and real examples to bring these ideas to life. Whether you're a seasoned investor or just starting out, our goal is to help you think like an owner, not a trader, building wealth with patience, structure, and confidence. Thanks for joining us. Let's get started.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Hi there, I'm Nadine. Welcome to Wealthy and Wise. Well, today we are taking a deep dive into the highs and the lows of reporting season, some of the key themes that have merged. These include extreme volatility, the strength of large and mid caps over smaller firms, and we've seen a pretty strong preference for defensive and quality names such as the banks and firms like AGL and Amcor. So how did the results align with the goals of value investors, and which stocks stood out to my guests from Teaminvest? But before we get into how Teaminvest rates the reporting season just gone and some companies in their portfolio, let's add some value with a look back at the February reporting season.
A pretty good reporting season, Nadine, I actually thought, overall, but really bumpy under the water. So the average pretty good, out of 10, 7. Earnings were up, dividends are up. Hard to be unhappy with that, particularly given the economic circumstances we've got. So yeah, we take it, but very, very different for very different companies.
Yeah, okay. So the miners really did drive a lot of the performance, but there were some companies, and I'll just name Woolworths, that absolutely disappointed back in August, but staged quite the recovery in February. Was that a stand-up result, and what can we learn from it?
Do you know what was really interesting, Nadine? The result was not as good as the share price movement, I have to say. This is an everyday goods retailer. If the shares can jump 8 or 9% on a day on the back of results, which were really good, they were good. But 9% better, 1/11th of the market cap added to the company after one 6-month result. That is crazy. Now, what it probably means is the market was too pessimistic beforehand rather than this was a blow off the doors result. But it was a very strong result for Woolies. And I think that was what it was. The thinking this time 6 months ago was, Woolies are getting beaten by Coles. This is a new model. Coles is the new superior retailer. Woolies is not very good. This is going to continue. And all of a sudden, Woolies comes out with a really strong set of sales numbers and kind of put the market back on its heels a little bit. So yeah, for a pedestrian company, you don't expect that sort of gain. The results, as I said, weren't worthy in and of themselves of that sort of gain from a fair price. The price was probably too pessimistic, at least in investors' thoughts, based on the last 6 months worth of data.
Was there any other company that really stood out to you that you could frame as a winner, so to speak, from reporting season?
There were plenty of good businesses in reporting season itself, and I think that's kind of one of the. There was some. I mean, look at the miners. BHP. BHP's dividend was up by $900 million, and that was out of a total. The MST Marquee did the numbers. Dividends increased by $2.4 billion in this 6-month period. BHP, $900 million of that alone. The miners had a really good result. The other was Commonwealth Bank. It was a very, very strong result. Profit up 6%. Doesn't feel like much. In a market where the banks are saturated, the results are pretty ordinary. They're dead flat effectively most of the time. 6% earnings growth. Now, same as ANZ. ANZ did it through cost cutting, CBA did it by growing the business. That was a very, very good result.
Now, anything in the tech space that interested you, Scott, because there's such a focus on tech right now, and also the widespread selling that we've seen in that sector?
Yeah, a lot. And in fact, there's a lot of stuff is becoming much more attractive than it was because of the SaaS apocalypse, as they're calling it. Not even so much earnings themselves. I mean, earnings were pretty good. The overarching thing is really sentiment, though. And I don't think any tech company could have done particularly well out of earnings season unless they were already massively beaten down. And the market thought, oh, that's a little less bad than we thought. So that was kind of the environment going into it. That's exactly what we saw. Other Xero was a very good number, very good result, and I'm pretty attractive at the current price. So that one stands out to me. Technology One continues to do a good job. Again, shares are down a lot. So you've got to separate the share price from the performance of the company. They were pretty good, I thought, in the tech space in general. There are some disappointing ones too. Zip fell, a third in a day. And again, by the way, good numbers, just not as good as the market wanted. And again, in earnings season, that's what we saw. If you disappointed the market, you absolutely got shellacked.
Mm-hmm. Now, disappointing the market. We talk often on this program about value investing versus value traps. BAT4 has got to be one of the lowlights of the season.
Oh, man. You know what's fascinating about that, too? They actually managed to grow sales. And you kind of think, well, they grew sales. That should be a pretty good business. Their underlying profit was barely a profit at all, $5.5 million, a statutory loss of more than $100 million. They were raising capital at what was 2/3 below the closing price before the capital raising was announced. This is one of those desperation raises. It can be nothing other than that. If you've got to give it effectively 2/3 off to collect the money you need to keep the thing afloat, you're going to take the deal. If they could have got a higher price, they would have. It's the market telling you what it thinks Bapcor is worth, given the challenges they're having. Covenants had to be renegotiated. A really, really ordinary set of results, and the market asking pretty much, will this be something that can survive and thrive? Or as you rightly point out, is it value or a value trap? The market's given its verdict. Now, might be wrong. Maybe Bapcor can pull a rabbit out of the proverbial hat, but this was once a market darling under previous CEO, Darryl Lobotomy, is now basically just bumping along the bottom, trying desperately to survive. How quickly the mighty fall.
No, absolutely. Now, any other sort of losers that you think as a longer term investor, you would read the results as, either a confirmation of your investment thesis, even though it was lower on the day, or as, something that is a harbinger of further bad news that you'd want to get out of?
So Coles sits between those two, and I'm going to kind of try and navigate the difference because the results were actually good. They got growth of 3.6 or 3.8%. I mean, it was a good result. It just wasn't as good as Woolies. And again, as much as Woolies was absolutely celebrated, Coles was smashed. The shares down like 7% on the day. I mean, these are grocery companies. This is not sensible investment results. Investment actions, I should say. The prices don't move that much, shouldn't move that much. And so that was really interesting. I thought the Coles result was much better than the market thought it was. It's looking at the two-horse race. It's picking winners and losers, and the share price are moving accordingly. Take yourself back 6 months. If you could have bought Woolies after what was, quotes, a disappointing result, you would have been very happy with yourself 6 months later. I'm not predicting that for Coles. I don't predict share prices, Nadine, but I think the market was unreasonably harsh with Coles. Neither is particularly cheap right now, by the way, so it's not necessarily something you want to jump into. But if you liked the supermarket space, if you wanted some exposure, if you were happy with the dividend, you wanted some safety, you wanted some diversification, you're looking at that part of the market. If the market gives you that sort of opportunity for no really good reason, yes, it's behind Woolies by a bit. Yes, there were some issues around underpayments of staff that had to be made in the current period. Those things are fair and reasonable. But was it really that big a fall? I don't think so. So Coles unfairly punished. Woolies unfairly celebrated, in my opinion. Doesn't mean either is necessarily worth buying, but have a look. There's opportunity there. You mentioned a place to go looking, though. I'll go back to tech again. I think you really should be looking very closely at the tech companies. They had some very good results across the board. Not every company, but lots of good results. And the market still is just ignoring it completely because this AI SaaS apocalypse we're talking about. Maybe it hits some companies. Got to be careful. Don't just assume it won't happen. But if you can find a quality business that had good earnings, like a Xero, and yet the market is ignoring it, there may be some opportunity to go fishing there.
So there you go. There's a fresh look at the highs and lows of reporting season. To delve a little deeper into that, I'm joined by Howard Coleman and Sanjee Narendran from Teaminvest. Gentlemen, welcome. Always a pleasure to see you there.
Leon.
So I'd like to know, when reporting season is approaching, what is the sort of thought pattern? What are you preparing for at Teaminvest?
Well, I suppose the first thing is we're quite excited because reporting season is the time of the year, there are two of them, but the times of the year when you get many more opportunities than you get at the rest, during the rest of the year. And this one was a terrific one because there was so much volatility. So many companies' share prices moved dramatically on the day. But as part of your preparation in advance for it, you've got to decide, firstly, how many companies am I actually going to be concerned about? And there's no way I think, maybe some people out there are bright enough that they could, but I don't believe anybody can really cope with more than 30, 40, if they're very bright, maybe the occasional person, 50 different companies that they can understand well enough to really look at. And as a value investor, what you want to choose is the companies that over a 5-year or longer period, you know from their past results have been really, really good businesses. And you want to focus on those. You don't want to worry about the rest because you'll do your head in trying to follow all the results. There were some days this reporting season when 20 or 30 companies just in the top 300.
Oh, I know,
On the
Howard.
same day. Yeah, it's a lot harder for you.
It is a lot of work. And so, Sanjee, do you have your portfolio companies, those companies in your portfolio? Do you have your calendar marked with the days? Do you have the consensus expectations? Or how do you make sense of the numbers on the day?
Well, I can easily remove the consensus expectation from there, but I have my own expectations. The way I look at it is reporting seasons are, on one hand, the exam for the next half, and it's also time to get your results for the test that you've taken in the last half and see all the decisions of the companies and how they've actually progressed and measure, have they delivered on where they thought they were going to be at this point in time, and what are they thinking about their future positions. So it's more assessing the business and understanding that that business is actually doing exactly what I thought it was going to do for the companies we're invested in. But in this, you take the same approach to companies that you want to invest in and say, have they been doing what they want to do? And now if they continue to do so, we get really great opportunities where the markets tend to overreact during a reporting season, sometimes on the upside, sometimes on the downside. And we can only hope that we get some bargains that I'm always fishing for on the downside.
Yeah, right. We have. This is just, the hallmark of this season has been the extreme volatility.
Absolutely.
Really shoot first, sometimes ask question later. However, Howard, isn't sometimes a 10, 14% drop justified?
It could be occasionally, but what's much more important is knowing, as a starting point as a value investor, if I invested in this company today, what return am I confident I could expect over the next 5 years? Not over the next 5 days, over the next 5 years. So what happens on the day of the report doesn't matter nearly as much to a long-term value investor as what that business is going to do over 5 years. And similarly, you want to ask yourself, at what price could I get the return I want? So say, for instance, you mention a company to me, for argument's sake, call it Commonwealth Bank, doesn't matter which one. If I was going to invest in Commonwealth Bank, what return would I want for putting my money in that company over the next 5 years? What return do I want? And if I know that, what return I want, what share price would I have to pay to get that return? Now, if you look at a particular company and you say, gee, the share price would have to drop 50% for me to get that return, well, you might as well scrap it off your list and not waste time looking at it on reporting day, because the chances of it dropping 50% are insignificant. On the other hand, if there's another company that you look at and you think, gee, I'd be prepared to take my money out the bank, put it in that company if I was getting, say, 10% return, and it's a very reliable company, and the share price would only have to drop 8% for me to get that. Wow, well, I want to see that report at 8 o'clock in the morning when it first comes out, because if the report is what it should be, and the market doesn't like it because the market doesn't understand the business well enough, it could easily, as we saw in this reporting season, drop 10, 12, 15%, and there I get my bargain. I'm buying for a lower price than I wanted to buy for to get the return that I want over the next 5 years.
So Sanjee, I mentioned it off the top, but one of the big thematics that we saw emerge are the big cap companies, those stalwarts outperforming the BHPs, the CBA, Telstra, for example. I mean, what sort of stood out to you in this February reporting season, and did any of the thematics attract you?
There's a lot of companies that have reported in the large cap space, and they've done well in their reports. It's stuff that I don't really spend much time on. I prefer to find the businesses that I follow and then I can make a reasonable prediction on. Because right now we're at a point in the cycle. Well, it's a different point in the cycle depending on which industry you're in. But if it's looking at the mining industry, we're at a point in the cycle within the mining industry where things are looking favorable on the gold side and silver and so on. But if you look at the financial services industry, things aren't looking so great on that side, or the funds management industry, things aren't looking so great on that front. So different industries will have different points in the cycle. For me, if I've identified a handful of businesses and they're the ones that I'm most interested in, I don't really spend a lot of time looking into many of the others, because these are the ones I understand the best and I can make a reliable prediction of what this is likely to do over the next, couple of years or next economic cycle.
All right. Well, let's get into the specifics then. We will go head to head and get into some of the Teaminvest holdings and how they rate the reporting season performance. Well, welcome back to Wealthy and Wise. So let's find out what Teaminvest has made of some of their portfolio holdings, companies that stood out, perhaps their own winners and losers. Howard Coleman and Sanjee Narendran from Teaminvest joins me now. And I guess, Howard, I'm being a bit dramatic about this, winners and losers, but for the purpose of this program, what did you actually make of them? So I know that JB Hi-Fi is a stalwart in many, if not most, of Teaminvest portfolios.
Sure.
Break it down for us.
Yeah, well, before reporting season, we were bombarded, as we are always for all but 2 days in the year. We are always 2 days that the market's open. We're bombarded always, and it has been in the almost 40 years I've lived in Australia, that retail is doing it tough. One of the first things I heard when I arrived in Australia the first time, before we even lived here, is I'd put on my television in my hotel room, and I would see on TV that retail is doing it tough. In the beginning, I actually believed it, because after all, I was seeing it all the time, that retail is doing it tough. The point is, some retailers are always doing it tough. They're badly run, their management isn't good, they're in the wrong venues, they're paying too much for rent, they aren't staffed terribly well. I mean, we've all had the experience. You walk into a retailer wanting to spend some money and nobody comes to deal with you. In the end, you walk out. On the other hand, there are other retailers that are run well. Now, I always joke that my grey hair gives me an advantage when I go into JB Hi-Fi, because when I walk into JB Hi-Fi, the young people who are there, who are generally pretty motivated, they look at this old bloke, they think, he doesn't know anything about technology, we should help him. And maybe we can sell him a lot if we help him. So they come along and I can act dumb and I can ask really basic questions and they will explain it all to me and I can nod and learn all sorts of things before I actually make a decision. Now, that's what a retailer should be. On the other hand, I've walked into, I'll give you another example, Harvey Norman many times, and I walked around for 15 minutes or 20 minutes And if I was lucky in that 15, 20 minutes, somebody may have said, can I help you? But most of the time, nobody said anything at all. And if you go to the department stores like Myer, you can even have bought something and you can't pay for it because there's nobody there to take your money. You've got to walk around for ages to pay for it. So in every sector, there are well-run businesses, not well-run businesses. So JB Hi-Fi, before they reported, the share price came down and down and down and got to the 70-something dollars because retail was doing it tough. And then surprise, surprise, they reported and their earnings were actually up. Their sales were up, their earnings was up, their guidance was up. Now, it wasn't spectacularly up. That's not the kind of business where you're going to get a growth rate of 20% per annum, but dividends up, payout ratios up, and overall it was up. So hardly surprisingly, it reported quite well. Now, if you did your homework in advance, you could have calculated that if you wanted a reasonable return on JB Hi-Fi, depending on what you decided was reasonable, but the figure that I had put into our software, I'd worked out that if the price got as low as $74, it was worth me buying a bit more. And the price, sure enough, got below 74. I could have got it a little bit less than that, but I got some at $74. So I landed up being quite happy. Now, if it had got to maybe $54, I may have backed up the truck. I wasn't going to back up the truck at $74, but I was happy to add to the position I already had at $74 because I could get a reasonable return. Now, other retailers have reported and they have been doing it tough.
Yeah. So it's finding the best in class, finding the price you want to pay for it. What stood out to you in JB Hi-Fi numbers?
The numbers, I mean, they came in pretty much as we've been predicting within Teaminvest because we've looked at the figures, we've looked at what they've done in the past, and we can see that JB Hi-Fi has a growth rate somewhere between 4 to 5% and 15%. You know, they kind of go in that range in terms of their earnings growth. So we know that we can make a reasonable prediction year on year that their growth is going to follow somewhere in that trajectory.
Mm-hmm.
So it wasn't a surprise to me to see the JB Hi-Fi figures. Seeing the market reaction, that's more of a surprise to me. I see these markets going up and down, and I looked at it saying, well, I bought it in when the PE was down near about 9 or 10. It was single digits when I first got into JB Hi-Fi. I've wrote it up and I've taken profits when it was a bit too astronomically high. But now it's a business that I'm just comfortable staying in and holding in. And as Howard said, if it gets down low enough again, it's a business that I would end up backing the truck up on.
But having said that, and I'm sure Sanjee, you'd probably say the same thing, there are not many retailers who would say that. Now, I don't know how many retailers there are on the ASX, but the vast majority of those retailers on the ASX, even if their price dropped 15 or 20% on the day, I would just say, yeah, badly run company. I don't want to be invested in that.
What about Wesfarmers?
Wesfarmers' result was, again, roughly what you'd expect from Wesfarmers. You know, it's not going to shoot the lights out. I mean, it may eventually, if it's a lithium operation, makes a fair bit of money. But other than that, it was going to report something a bit better than it had done a year before, which is what it did. And the share price came tumbling down. But if you look at why most of these companies have had big drops in price, it's because they were on ridiculously high PE ratios to start with. Wesfarmers had moved up to one of its highest PE ratios we'd seen for years. So it's not that surprising that it came down. And when JB Hi-Fi got to whatever it got to, over $100 a share, its PE ratio was too high for a retailer. When it got down to under $50 a share a couple of years ago, it was on a PE of less than 10. So if you look at the companies prior to this reporting season, those that a year ago had high PEs have tended to come down. Those that a year ago had low PEs have tended to go up. And the reason for that's pretty simple. PEs are mean reverting. Nothing goes up forever. Nothing goes down forever. And part of your preparation for reporting season is pick the companies, as Sanjee said before as well. Pick a small number, smaller the better. Because of my role in Teaminvest, I tend to pick more than I would be interested in buying myself. So, I look at maybe 30 or 40 companies. I wouldn't want to own all of them, but at least they're ones that pass all our filters, and watch those. But as I said earlier, how much, if I want a particular return, how much would I be prepared to pay to get that return? That's the key.
Has anything come up in reporting season, Sanjee, that you think, oh my goodness, I didn't realize that company was doing so well. I've got to get me some of that.
No, because I wouldn't have been watching those companies. The ones that I'm watching, they haven't surprised. And it's pretty rare that we get a significant surprise from the companies that we'd watch, because we do spend a lot of time watching these companies and getting to know the businesses really, really well. So it's less likely that we end up surprised. We usually expect a decent result coming out of the business, and more or less in line with that range of what we're thinking is where the business ends up. Every so often we do get a surprise, occasionally on the upside, sometimes on the downside. But as I said before,
so here's a question.
One that reported that I was surprised, Sanjee may not have been, but I was, is Monadelphous, which is clearly a cyclical company based on what's going on in the mining industry, came out with an astronomically good result. Now, I expected a good result from them, but this good result was much better than the good result that I expected. So its share price on the day rose about 15% at one stage during the day. Now, there was a big surprise. But as Sanjee said, generally they're not a surprise, because which companies are we looking at? We're really only looking at great businesses that have been predictable in what they do. Now, of the 2,000 or nearly 2,000 companies on the ASX, about 1,800 of them, you couldn't possibly predict anything. It'd be like throwing darts at a dartboard. They're all over the place. So how could I make any prediction before reporting season on those? Monadelphous is one that I was prepared to make a reasonable prediction, but I certainly didn't expect it to do quite as well as it did. Share price rose. I looked at it and said, oh, well, I wasn't going to buy it before. Now I'm definitely not going to buy it, even though it's so good. And Codan was another one that perhaps did a little better than expected, but they gave us some guidance only about 4 or 5 weeks before reporting season, saying they were going to have a bumper result. And it wasn't much different in the end to what they actually reported.
So that was already in the price. So you have to be very careful that what you are buying that is not already in the price. Here's a question. I'm putting you on the spot a little bit, but Data 3 reported, and while it seemed to come in line with expectations for me, I'm not you, and I believe that Teaminvest does like Data 3 because it's come up on this program before. Share price was down by 14% on the day. So did the market just get it wrong?
Well, the market gets a hell of a lot of things wrong because it's looking at too many different companies. And I mean, I'm not blaming people for this. If I worked for a broker or somebody who had clients who were constantly wanting my advice, I have to know a very, very large number of companies. How well can I know them? Not very well, but I'm required to do that for my job. Fortunately, as a long-term value investor in Teaminvest, I don't have to know very many companies, so I can know them much better. So if you take Data 3, their result wasn't great. It was good, but it certainly wasn't great. Share price plunged ridiculously for a result that was quite good. And funnily enough, I actually got about $30,000 worth of them because I had an order in at $7.54, which I'd worked out that at $7.54 or less, I'd be really happy to add to my holdings. And it dropped on the day all the way to $7.19 at one stage. So my $7.54 order got filled early in the morning.
Right.
Now, it wasn't a giant amount of money. I was only adding to a position I held. And again, as I said earlier, you've always got to distinguish between, am I going to back up the truck or buy a small amount? Most of the time, you're buying a small amount. Occasionally, what happens is something drops so much that you get your small amount, you look at it, you say, this is crazy. It's got another 10 or 15% lower than I would have been happy to pay. Well, then you may consider backing up the truck.
Yeah, right. Sanjee, any anecdotes from reporting season for you in your portfolio?
Yeah, I learned a really valuable lesson that you sometimes got to keep your powder dry, because I went in quite deep, quite early with some of the opportunities, because I've been a patient buyer for such a long time. I've been coming on the call and saying, no, wait it out. Yeah, market's going to crack, market's going to crack. Market started cracking and I got very excited. So I ended up, with the first few opportunities, I went in pretty deep. And now that there's more opportunities presenting us, I'm like, oh, I wish I had more powder that I'd kept dry.
Yeah.
So that's my lesson for this reporting season. But going into next one, I know that I'll keep more powder dry and kind of spread it across the whole season, not get so excited at the beginning.
Well, that's the thing. We're all learning.
Yeah, and that's happened to me a couple of times too. You get towards the end of reporting season, and one of the last companies that reports that's on your list, the share price really plunges, and you look at it and you say, oops, I haven't got enough cash to buy as many as I would like. I've only got to buy a tiny little bit. But, as an investor, you've got to accept you will never, ever get everything right. We work on the basis that with the way our software works and the way our systems work, we're going to get 85% positive surprises and 15% negative surprises. Now, you never like the negative surprises, but they'll happen. And sometimes, even the Data 3 I mentioned, I paid $7.54, it came down to $7.19. So if I'd put in the order at $7.24 instead of at $7.54, I would have got them as well. But I'm not grumbling at that rate because it was more than my required rate of return anyway at $7.54. So, you shrug your shoulders and you say, I'm never going to get them totally right. But if I concentrate only on the small number of companies I know well and that are predictable and I can make decent estimates, I'm going to get most right. If I focus on the sort of companies that never make a profit, that I'm hoping their story will sell, or if I focus on the companies that their earnings are all over the place, up and down every 6 months, I'm going to get a hell of a lot of errors. So traders make a lot more mistakes than long-term value investors. Now, some of the traders put a lot of effort in it. They're doing this all day, every day. And despite that, they make a lot of mistakes. Now, the best among them, of course, do well. But generally, it's a tough job. I'm semi-retired. I don't want to be doing all that work. I want my job to be fairly easy, Set it up for reporting season, know what I'd be prepared to pay at which price. And by 8:30 in the morning, 9 o'clock at the worst, I've read the couple of ones that I wanted to read, said, oh, goody, I'm glad I've got that order in, or I'm going to change that order and make it even cheaper because it could drop a bit, or now I probably won't get that one. I'll be very lucky if I get it. And then I want to go and do something else.
So, Sanjee, you learned a lesson this reporting season, which will set us up nicely for August. When you look at your companies in your portfolio, and obviously you don't have to reveal all, but how would you rate this reporting season overall? Because we were in this macro environment where we're very uncertain, geopolitical risk, headline risk, plenty of questions around software and AI. On a scale of 1 to 10, how do you think it went?
I'm ecstatic about this reporting season. I think I personally in a position that I've been in where I'm got the ability to deploy capital. I've managed to pick up some of the best companies that have been overpriced for such a long time that I haven't had the opportunity, and I've been itching to get into, but I just haven't had the opportunity to buy in. But now I'm getting a lot of those opportunities are starting to show where I have been able to deploy my capital into great companies. So if I'm taking a long-term view, this reporting season, next reporting season really doesn't mean too much to me, except for, as I said earlier, it's a scorecard on, is the business doing exactly what I expected it to do? And as Howard said, we've got a rate of return that we decide that we want out of that business. Saying if I'm investing into this business, I'd like my return on my investment to be 9, 10%, 15%, whatever you choose. And if I'm getting that, and if I'm getting that from the business in their profits as they're growing, then I'm a happy camper, because 5-10 years from now, I'd forget, what share prices I ended up buying at. And if I could have got it at 30 cents cheaper or, $5 cheaper on some of the larger stocks, it really doesn't make a big difference to to where I hope to be in 5 years' time.
All right. Look, Sanjee, Howard, you're sticking around after this very short break to answer one of our viewer questions because you asked. Welcome back. Well, Roz has written into us and she's kept it pretty simple, but kind of complex as well, if I do say so myself. She says, what if a company has cut its dividend? Is that enough reason to cut and run? So maybe, Howard, just to set the scene, thanks, Roz, by the way, give us your sort of take and your, I guess, investment philosophy thesis when it comes to dividends.
Yeah, well, to start with, dividends is part of the return you get from a company. And imagine if a company wasn't listed on the stock exchange and somebody approached you and said, I own a business. Would you like to buy a piece of my business? Probably one of the first questions you'd ask is, does your business make a profit? And if they said yes, you'd say, well, are you going to pay me some of those profits every year? And if they said yes, you'd say, well, how much? You know, what percentage of the profits are you going to pay out for my shares? And if you were happy with that, you'd invest in that business. If they said, well, I'm going to pay you 0.25%, you may say, well, that's too little. I can get 4 in the bank. If they said, I'm going to give you 6%, you say, okay, well, if I'm going to get some capital gain as well, that may be okay. The question is, why does a company cut its dividend? And there can be a couple of reasons. Often a company cuts its dividend because it didn't make as much profit as it was making before. If that's the case, it may well be a good reason to get out. Other times a company may cut its dividend because it's got too much debt. And the bankers have come along and said, you've got to reduce your debt. So it can't pay as big a dividend because it's got to reduce its debt. That's not a good sign. Debt's a 4-letter word, as we often joke. And you'd probably want to get out. On the other hand, if a company says, we're reducing our dividend this half year because we've just made that wonderful acquisition, small bolt-on, that's going to enable us to, for argument's sake, operate in New Zealand as well as in Australia, and we got a real bargain on it, and that should deliver far more than we paid for it over the next couple of years, then you may say, okay, that's sensible. I don't mind that they cut the dividend. So the fact that they cut the dividend is usually a warning sign, but have a look at why. And remember, they'll try and paint the most positive picture about it. So try and read between the lines. And when you're reading the why, check it out a little bit more carefully than just the one sentence they say about it. But yeah, that would be the way I would look at it.
Yeah. Okay, so if a company is reinvesting, it's not necessarily a bad thing if the dividend gets cut. As a value investor, are dividends always part of the investment thesis for a company?
No, not at all. It's it depends, as Howard said, on the reasons of why they're paying the dividends. And we're lucky within Teaminvest when we look at a business, and part of the due diligence process that we run into deciding whether it's a good business or not, asks the question or makes us answer the question, are the management good stewards of our money? So when we're invested in these business, is the board and management able to allocate capital wisely? And if they're not, that's probably a big red flag for us not to invest in that business. So it's only after we've already considered how have they been allocating resources, how have they been issuing capital. So it doesn't affect us as much. But I know from being a broker, people are very specific about how they set up their portfolio. Some are very reliant on the dividend returns and franking credits and things like that. Other people will want growth. So people try and categorize them into 2 different categories like that. I'd prefer not to, but I understand why they do. But I think cutting a dividend is not necessarily a bad thing, as Howard said. It depends if the management is strong and good with the capital. Maybe cutting the dividend allows them to grow the share price more. So in the following years, the amount of dividends returns back to you. But if they're not good stewards of capital and they've blown it up and that's why they need to cut the dividend, then it's a question I'd be wanting to ask myself is whether I continue holding it or not.
Yeah.
So the question often really is, how well do you know how good this management is at stewarding your capital? Because if they've always been good, the chances are they haven't suddenly turned bad. If they've often made mistakes and allocated capital poorly, there's a good chance they'll make a mistake this time too and allocate it badly. So, past experience with people tells you how likely they are to get it right or wrong. They could make a mistake, but generally that tells you that.
All right. Well, Roz, I do hope that helps. Howard Coleman, Teaminvest, Sanjee Narendran, Teaminvest, I appreciate your take on reporting season. Really appreciate your time today. That is Wealthy and Wise for today. Thanks for watching. We'll see you next week.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.